investments in Web3. So just to kind of reset here, let's just do maybe a quick 15-second intro each, and then we'll just get right into the meat of it. So I'll just go ahead and kick it over to you, Tiffany, and then but just keep your mics close to your mouths, and we'll get the best audio.
Cool. Tiffany McGee. I'm a founder, Chief Investment Officer, and CEO of Pivotal Advisors. We're an OCIO firm, and we basically manage money for foundations, endowments, pensions, institutions.
I'm Mark Yusko from Morgan Creek Digital.
Sam Yilmaz from Blockcelerate. Nice to be here. Thanks. Yeah, we do invest in Seattle startups. So, thank you.
Jonathan, you're recycling your panelists. It's good. It's good for the environment. I'm still Isaac Kanto, Managing Director of Filecoin Techstars and Techstars Seattle, serial entrepreneur, long-time investor, et cetera, et cetera.
Awesome. Well, thank you all for joining this panel. And so our goal in this conversation is to talk about the venture side and just the business aspects of it. How are people and folks like we have here thinking about making investments in Web3 companies at various stages? So my first question is going to feel almost like an elementary question, and that is there any difference between investing in a Web3 company versus investing in a Web2 company? That's to anybody, jump on in.
Can you define a Web3 company, please?
Yeah, what's funny is that could almost be up for interpretation, right? Because though developers in the space have been calling it Web3 for a long time, call it the marketing engine took over Web3 maybe a year and a half or two ago. So how about anybody that associates themselves to crypto, blockchain,
Sure.
NFTs, et cetera? Do you look at a company like that, or is there any difference in how you might look at a company like that versus your, call it, traditional non-crypto-based business?
So there's definitely a similarity in how one would go about evaluating Web2 companies and Web3, in that Web2 companies, when they were getting started, they were looking to power their infrastructure with Web2 native companies themselves. So there has effectively been this, Netflix building on Amazon, AWS, instead of going to on-prem servers powered by IBM. And we see something similar unfolding, where Web3 initiatives are recruiting service providers that are Web3 native themselves. They're going to Stably and Zenledger and Blockdaemon for powering that kind of infrastructure, or QuantStamp. They're not going to KPMG or Accenture for doing their audits and doing their first iterations of their application. So in that regard, there's Web3 initiatives that are leveraging Web3 native service providers, and we find that's a very fruitful area to be investing in.
I would say that investing in the company is the same. You're trying to back great founders with a clear vision. The subtle difference is ownership. So in the good old days, there was only equity. Today, there are differences between owning equity, owning tokens, investing in a DAO, and I think that creates some unique differences in how you approach the ecosystem. But the basics of the company investment, it's funny, I did a tour down in Silicon Valley back in the last bubble in 2000, and I asked 40 firms, there are 4 things to do venture. You need research, you need money, you need entrepreneurial talent, you need venture capitalists. What's the most important? Only 2, the best you would expect, Sequoia and Benchmark, said, well, of course, it's the entrepreneurs. The other 38 all said it's us, the VCs. It's not the VCs, it's the entrepreneurs. So I think that ultimately is what it's all about, backing great people with great ideas, but there are some subtle differences in how you affect that investment.
Tiffany, do you have something?
Yes, I can just tell you how we think about it. I think it's probably a more kind of broader definition. So I'll drop a Mark Yusko quote and really talk about the fact that investing is about asset classes and innovative ideas. And so when we're investing for our clients, we're investing the entire portfolio. We're making direct investments into capital markets in the way of individual stocks. We're also investing in funds and also alternatives. And so when you break down that bucket of alternatives, certainly hedge funds, venture, and private equity. But we are really, interested in innovative ideas and big themes. I think you also mentioned that as well. And so for us, and by the way, we invest everything through an ESG lens, so environmental, social, and governance lens. And our clients are organizations, institutions who really want to use their powers for good, right? So right now, where we are in our current economy, in the current world, is we're really standing in the intersection of still a global pandemic, a crisis in climate change, as well, particularly in this country, an epidemic of systemic racism. And so our clients want to use their powers for good, and they want to use their endowments, their foundation dollars to create impact, but as well without sacrificing return. So we are, even though we do invest across the whole portfolio, multi-asset, we do, if I would say, we would have a tilt towards growth, and that really comes with like innovation and also venture. So we are looking for opportunities in Web3 because number one, we think that it's a way that our clients can kind of create impact. We think it's a way that kind of building an inclusive economy, because it is very much about inclusion, not in the way that I would think the internet or maybe even kind of Web2 was. And so, yeah, it really is for us about innovation and inclusion as well, and correlation, right? So when you start to construct a portfolio, you need certain things to zig while others zag, and digital assets actually have the least correlation to traditional stocks and bonds right now.
Tiffany brings up a really, really important point, which is the primary difference in my eyes as well, is the consolidation of wealth and power at the top versus the broadening of wealth, power, and ownership to the masses. And you've heard lots of examples of companies that are trying to bank the unbanked or the underbanked, trying to create more inclusion. And I think that is the biggest differential opportunity. It's why I also think that we get this upswing in value creation. And most people can't appreciate the future because they can't imagine the unimaginable, right? They can't imagine that you could have an entire country that doesn't have the access to cheap electricity or food security or water, all kinds of things. And so if you think about what's gone on in Silicon Savannah, example, where they took cell phone minutes and created an entire economy based on that asset, well, you can extend that into other opportunities in Web3 that are even more broad-based and really create that ownership economy in ways that we can't even comprehend. And again, American exceptionalism. If I asked most people in this room how many people are in Indonesia, I get a range from probably 25 million to 300 million. And it's 265 million. That's probably off by 10 million because I'm not exactly sure. But that lack of understanding of how big the rest of the world is and how big that opportunity is, I think just creates opportunity for all of us.
Yeah, definitely. So Isaac, actually, I want to give a shout out. The Filecoin Accelerator has your launch coming up, right, for the whole cohort?
And the program showcased finishing up the first cohort.
Awesome. Yeah, so we have some cohort members from Filecoin Accelerator, so you should definitely talk to them. Some awesome, innovative companies. Techstars Seattle, this is the first blockchain-focused cohort. I know Techstars has done a handful of them. How did you approach this as opposed to how you might have approached past Techstars cohorts?
Honestly, at this stage, which is very, very early stage, most of the companies we pick have identified a problem that they want to solve, and they've at least started building towards it. We actually do have some later stage companies. We have one company that has $1 million in trailing bookings heading towards 4 this year, but that's unusual. They're pretty early stage. I would actually say that a lot of the vetting process really wasn't that different in that at this stage, what do I care about? I want to find great, world-beating, amazing, brilliant, gritty founders who I think have a good chance at building a really high-performing organization. That's always something I'm going to look for in any human endeavor, basically, right? I want to see a big market opportunity. Obviously, when you have a token native kind of thing, that can be much harder to size up, right? I can't just say, tell me how many millions of customers you're going to have times how much they're going to pay you per year if the main incentives are on tokens. So that can be difficult, but you're still trying to gauge, could this be a big ecosystem? And those things are fundamentally true no matter what. I think the other important thing is I still want companies that are either solving a real significant pain point or addressing a real strong desire and need for something, and that doesn't change. I do think in the more euphoric times in the last couple of years, that kind of got thrown out the window, at least for a number of blockchain, crypto, Web3 things, which is, hey, idea, start up a Discord channel, mint a coin, make billions. That's not, I don't think that's going to be, there may be periods of time where you can get away with that, but I still want someone who are teams that are building real things for real companies or people.
Yeah, it's interesting. I remember in 2017, that used to be, kind of like this investor feedback. It's like, oh, you're just trying to blockchain everything, right? And we've heard that in different industries. Oh, you're trying to AI everything. Oh, you're trying to e-commerce everything. I think we've passed the, you're trying to blockchain everything phase, right? Of course, there's always going to be founders who are perhaps young in their founder journey, so maybe they don't know everything they have to have behind them. But as you said, you found companies that are solving a problem, and I know all of you are thinking of it from that point of view. So, Mark, you mentioned about how we're this close to getting parabolic phase. Are the problems bigger in Web3? Are the solutions bigger in Web3? What is it that helps define this parabolic state? Is it a redefining of existing rails and architecture? Why is that interesting from a VC hat?
Such a great question. So two pieces. So one is, again, just the massive theft that goes on in the traditional financial system. Right, the financial system's had a good run, 800 years. Pre 1200, 1300, we had single entry accounting, and I would lend you money, Jonathan, and I would write down in my ledger, did you owe me $100? But if I was unscrupulous, I'd write down 200. You'd come back with 100, and I'd go, oh, nope, you owe me 200, and you had to trust me. So the benevolent Medicis came along and stole an idea from brother, whatever his name was, and said, all right, we're going to do dual entry accounting, and you write down 100, I write down 100. Now, to make sure that I don't write down 200 because I'm unscrupulous, the benevolent Medicis, for a small fee, will arbitrate and be that trust agent. And so banks, for 800 years, have had this good run of being that trusted third party. And there's, by estimates, 7 trillion. Okay, come on. Someone shudder when I use the T word. We throw around a billion, trillion. I'm gonna lock the doors. You guys gotta sit here with us for 31,710 years. And we gotta spend $1 every second. That's 1 trillion. Forget 7 trillion. That's 1 trillion. So $7 trillion every year is wasted, pilfered, stolen from us, the participants. What is it, $8 billion a year in overdraft fees from the people who can least afford it. And the banks actually use software to hold checks, hold deposits and cash your checks first. So you overdraft even though you thought you were going to put your money in time. So it's just horribly exploitative. And a transparent ledger-based system, triple entry accounting, can stop all that. And I don't want to monopolize too much, but that's the first. The second is, if you haven't listened to Jimmy Song talk about this, you have to, is if you have a currency where you are a slave, highly charged word, you are a slave to your job, meaning you're paid, and then the government can steal your wealth through inflation, that's an inflationary currency, versus a deflationary asset like Bitcoin, where it's a fixed supply and it appreciates over time relative to that devaluing asset, you suddenly unleash creativity because you have to spend less time defending your wealth and more time being creative, being part of these communities that turn into economies. And that's where I believe you get this just asymptotic, because human creativity, we don't need less people in the world. We need more people in the world. Humans solve hard problems, and the best humans that these guys back solve really amazing problems and create untold wealth. And the wealth creation that will come out of this economic boom is just, it's unfathomable. But I don't feel really strongly about it.
Tiffany, I could tell that was like sparking some thoughts from you. Do you want to add to that?
Yeah, I mean, you kind of started off your comments by really talking about the power dynamic in our current global economy. And when again, like you think about how the internet was supposed to be this decentralized thing, and we see like 4 stocks in the universe kind of have 20% of the S&P, right? And so we all know what those stocks are: Microsoft, Apple, Facebook. I refuse to call them Meta. And what's the other one? Google. Yeah. So I would argue that it did the exact opposite, right? It didn't democratize anything. It didn't decentralize anything. It did exactly the opposite. And so, and really, where that power flowed was into the hands of people who had enough resources to innovate. Right? Because it's one thing to kind of think about things in your head, but you have to actually kind of bring it to fruition, which requires, usually money.
To that point, Tiffany,
Right.
in the 18 months following the lockdowns, $3.7 trillion went from the middle and lower classes to the billionaires.
Yeah. And
3.7 trillion.
And in that time, in 2020, in probably like the 6 months kind of following, from March on, we had more small businesses start than in the past 15 years, right? And I would be on halftime talking about this all the time. I'm like, I think the world's changing, because we're all sitting at home. We've been in this like rat race, having to get up and get ready and commute to work, and then spend most of our lives at work and then come back and be without our families and our friends. And now we've all had time to sit and think and just press the pause button for a second. And I think a lot of people were like, wait a second, I don't kind of like what I do on a daily basis, but I know I have a skill, and since I'm sitting here and I have no place to go or no place to really, really be, let me see what I can't come up with in my kitchen with my mind. And a lot of that was, a lot of people invested, right? And so that's why we see those huge valuations where like, and I don't know what you said about Peloton. Would you say Peloton? And I still own Peloton and I'm gonna ride it, okay? Totally, like literally. But that's where we see all these like huge valuations kind of like run up because everybody was sitting home just pretty much watching CNBC. But again, out of that really came a lot of not just innovation and ideas, but the guts to do it because we literally had nothing else to do.
Yeah.
So yeah.
I mean, what I'm hearing from both of you is it sounds like there's a tremendous amount of opportunity and founders who are taking advantage of these opportunities. And so, Sam, what are you seeing? What are the types of companies that are coming across your table that you think are just interesting? And how have the body of those companies matured since, call it, the last crypto winter?
Actually, to the point of why this is parabolic, to add to that, effectively all assets are as valuable as the contracts that... Closer? Okay. All assets are as valuable as the contracts that retain the rules around them. So you had the same land in a reliable jurisdiction versus non-reliable jurisdiction. The confidence you have on the rules of the asset are lower, so you would then monetarily value that less. So what we are enabling with Web3 innovation is making these assets, declare them on-chain, and give them rules that we are all in consensus on how they will behave downstream. And that makes these assets much more valuable as we can opt into systems. We know the rules that we are willing to play with, and we're given a clarity, a transparency, and auditability to the rules of the systems that we're being part of. I think that's going to be a driver for value creation. And in particular, it functionalizes all of us as entrepreneurs, as thinkers, to empower members in a DAO, empower members of a Web3 ecosystem to engage with each other in a pre-programmed, understandable, intelligible ways. And to the extent that we create value in interchange and exchange, the more pre-programmed, predefined, standardized exchanges we can empower people to make, the more value these systems will create. So I think that is what adds to the parabolic nature of the eventual value accrual in Web3. In terms of the kinds of companies we see, we do take a position which is slightly different from the STAT protocol approach, that the next decade we'll see a layer of service provider applications and companies that will help the old school enterprises pivot and become more on-chained, pre-programmed, auditable, transparent workflows where the costs of coordination that justify these firms' existence are actually brought on-chain. And then those service providers will be the ones empowering the new breed of web enterprises, that the enterprise of the future, the DAO, will be relying on similar service providers that very well power the enterprises to evolve with the times. So we take a position that that layer of the tech stack, that breed of companies are good and worthwhile equity bets. And in terms of Web3 applications, obviously tokens that incentivize the participants unleash the potential for contributing value and participating in the value creation. So we recognize those as good opportunities as well.
Yeah, for us at Filecoin Techstars, I think one of the themes that runs pretty consistently through most of our companies is that I'm just fascinated by the ability of crypto and blockchain and Web3 to turn to turbocharge a typical Web 2 conventional business, either through cost reduction or through value creation through market and marketplace enablement and supply formation in ways that have never really been able to be done before. But we have a company in the cohort called Transcripts. They have a very simple enterprise model. They do employment and credit verification for big enterprises. They can charge in a standard fiat way, but their costs for servicing are so much lower than a conventional mode. But by the way, because they're putting all the data on a ledger down the road, the opportunity to allow the data owners to monetize and control their data in a way that's not possible through the current regimes is amazing. Okay, same thing with Bailport. It's a money remittance business. It's a competitor with Western Union and Remitly, which is a Techstars Seattle alum, but the back end is so much cheaper because it's over crypto rails. But I also think the kind of marketplace enablers then and supply formation that a token incentive provides is amazing. And Protocol Labs is a great example in its own right. Filecoin is now a 16 exabyte decentralized storage network. That's 16 million 1 terabyte drives, all created on the incentive, on the supply formation incentive that the token provided. That is amazing, and it was built up in a matter of a year or two. It's just incredible. So things like that I think are fascinating. At the end of the day, it's a storage network. It's cloud storage, but done on a much cheaper and decentralized basis.
Fascinating. Lots of great companies. Just quick survey of the room here. Raise your hand if you're a founder or have been a founder. Doesn't have to be a Web3 founder. But if you're a founder in the room, raise your hand. Awesome. And then keep your hand raised if you would consider yourself a Web3 founder. Awesome. So what advice do you have for people right now who are raising in Web3? There's a little bit of a narrative in the broader VC market right now that term sheets are getting taken away or valuations are dropping. Are we seeing that in Web3 as well? One, and then two, what advice would you give to a founder who is raising for their any stage? Call it pre-Series A in the Web3 space.
Well, I think things are going to be tough. I don't know for how long, but however much money you thought you were going to raise, say 2 months ago, you should probably knock it down. You should be a lot more sober about your valuation expectations, and you should expect that it's probably going to take longer. I still think that there's tons of money that's going to go to work still, but I think most investors don't feel a ton of pressure to pull the trigger fast like they might have even a month or two ago. If you're on the early stage side, I think you have to be really careful about doing a speculative token issuance at this point. I think that is going to be really, really, really hard. But even if you could pull it off, I might ask myself, is now the right time to do it? Okay, because who knows how long the market will be down, but also, whereas you might have been able to get away with a rush token issuance before, I certainly advocate to my founders, please get your tokenomics and your tokenization bulletproof, do the simulations, make sure that it really, really works, and probably think about raising a more conventional equity round with a token warrant first, because it ultimately provides you with way, way more flexibility than what you'll have once you push a token out. And people forget that being a small cap public stock really sucks, okay? It completely limits your fundraising ability. It, in many cases, hampers or kills the company. I think the same thing is true with doing a lousy token or busted token issuance, okay? Once it falls below a certain point, it's almost impossible to take it back up. So maybe don't rush that out too fast, okay? If you can raise equity, you buy some time, you make sure you have things lined up, and look, worst case that happens, you were being a little too conservative, and so 6 or 12 months from now, if things bounce back, then you can do your token issuance.
So I think the entrepreneurs that have worked with us would know this about me, that we want to be absolutely clear as to why this and why now. We are time-bound creatures, and we've had many examples we covered of misplaced but brilliant ideas in just a temporal landscape. So why this needs to be super clear, and that means what's the value we are unearthing? What is it that we are enabling that was previously impossible? And why now is what's the infrastructure element that needed to be here that have just made this possible? And it's not just technical infrastructure, it's also psychological infrastructure. That is the user base ready to engage and see the value of what it is that you're offering right now?
Yeah, and there's nothing new in this world. We've seen these cycles before. People do temporarily lose their minds on both sides, both the entrepreneur side and the venture capital side. So, as a guy who used to allocate to venture capitalists and watched this, now as a venture capitalist, valuations are definitely down. So the bad news is valuations are definitely down, like a lot. Like I've heard 80-ish% on average in a lot of cases. So that's real. That's the bad news. The good news is, again, throughout my career, which is longer than many, I've seen multiple cycles, and the best investments we've ever made have been in the bear market cycles, right? And there's a couple reasons for that. One, good people get displaced from stable jobs where they were happy and maybe too comfortable. And life is about living outside your comfort zone, so they're forced to take a big opportunity, and that usually, if somebody's talented, results in really great stuff. The second piece of it is the talent migration into this space. And when I say this space, I mean all of a blockchain-related industry is like nothing I've ever seen. I said I've seen multiple cycles. The internet was close. You had people coming from every walk of life, from banking, consulting, healthcare, tech, everything, all ended up in early stage startups around kind of Web 1.0. And it was amazing. This is bigger than that. Bigger. And the quality is better, and the tools are better. And that showed a little bit 6 months ago, 4 months ago, 2 months ago, where people were saying, oh, I got an early stage startup idea. How about 100 million? Stop. And so now you actually have to tighten the bootstraps. And again, one thing I've seen throughout my career, the least well-funded companies do the best. The most well-funded companies crash and burn. Crash and burn. Because it's, and I had explained to me by a venture capitalist a number of years ago, he said, it's like when you're a family. When you're a young family and you want to go out to dinner, you save up for 3 months, you put the kids with the parents, You go out, you split an appetizer, you split an entree, you get dessert, you have 7 cups of coffee. It's glorious, all right? Later, when you have a little money, you throw the kids in the back of the car, you go to McDonald's. And I guess we should all buy McDonald's stock since I talk about it so much. But it's not as good. And it's because you don't care about the money. And we've all seen the stories of the big fancy offices and the big cars and the big parties. Like Solana spending $1 million in Portugal at the party was the day of the peak. I mean, the day of the peak. So don't spend $1 million on a party. Don't buy a big fancy office. Just work. And so bad news, valuations are down. You're going to have to tighten the bootstraps. You're going to have to be more creative. But we are still deploying capital actively. We'll do probably 8 to 10 more investments this year. We've got 21 in the fund, and we target 30. So we'll do 8 to 10 more this year. So that's just one VC's perspective.
Yeah, and same for us, by the way. If there any of the Web3 founders are interested to, make a round happen.
More portfolio company here, stably. I like that. I like seeing that.
Yep.
I just want to double down on one thing that Mark said. I could not agree more about the quality of people that have been attracted to the Web3 space. It is an order of magnitude, if not more, than it was during the internet era. And look, there are fundamentally real problems with crypto and Web3, like the energy intensity of proof of work. Okay, that really sucks. That's a problem that must be solved with. Pick your other.
Doesn't spend as much on non-renewable resources as aircraft carriers, but
sure. But there all of the UI UX problems. yeah, exactly. All the UI UX problems. But again, when you look at the first hosted software in the early 2000s, late 90s, they sucked too. Okay, it was hard to make an argument in some cases why hosted software would be better than on-prem software. But over the long run, the kinks got ironed out, and I fully believe that that's going to happen here. There are just too many really smart people working on the hardest problems. The people at Protocol Labs, and Juan Benet is a polymath. He's stunning, and all the people around him are stunning. So I quite think that a lot of these things will get solved. Maybe it'll take longer because maybe the problems are harder, but they will get fixed.
Add really quickly. So I think the first thing is, and so we invest directly in VCs, but we also do some direct deals. We have family offices as well that don't want to go the VC route, but want to just go to direct deals. And I think I look at decks every week, probably more than I would ever imagine to. And then also done some work with Jonathan in his virtual accelerator, where we just sit down with founders and just go over story and pitch and all this stuff. And I think the first thing, especially if you're coming, depending on if you're in a raise, knowing what type of investor you want. So not everyone's going to be a good fit for a VC. Maybe angel, understanding what friends and family means. But also what kind of, if you're ready for institutional investment, what type of institutional investor, right? Like a family office might be a better fit for you. There are lots of foundations out there that are doing direct deals outside of the work that they're doing with their main portfolio, with their OCIO. And so I think, or coming to an OCIO like my firm, so you should really understand, what my job is, right? What, like Mark's VC arm, what his job is. And so at the end of the day, I work really hard to get my clients. I've got to sit across, my team and I have to sit across from people who often don't look like us and ask them for $100 million to trust us with your $100, $200 million. So when we go to start to build a portfolio, we better get it right. We don't really have a lot of room for error because it always reflects on us. We can't blame you guys. So I think understanding who you're sitting across the table asking money for and understanding their job is really important. But then also just getting basic things together. Like I know these guys talked about some fancy stuff, but don't send me a 27-page deck. Just don't do that. Don't have paragraphs upon paragraphs on a page. I just looked at a deck last week of a Web3 company, and I was like, I can't even read this. It's like 5 paragraphs on a page, no margins. It's like you don't even understand PowerPoint. So how am I to believe that you really understand how to execute this? I mean, that's a bit of a stretch, but make it, I always tell people, be the best part of my
Will
day.
you send me that deck? Because in my experience, there's a perfect inverse correlation between quality of marketing and quality of investment. And I'm not lying.
Well,
No, I know.
so,
I know.
and I know what you're about to
I
say,
know.
but the overall point is story. And,
Oh, I know.
and with these particular people, listen, at the end of the day, I have to understand it. If there's so much on the page where I have, and I think I'm kind of smart, right? Where I have no idea, where you can't take me from point A to point Z without me understanding like the natural progression, that's a problem. Now, again, I don't need you to have the prettiest deck. I didn't say pretty.
right.
I just said effective. I need you to be able to tell the story, because you can have the best idea in your head, and if you can't effectively communicate it to me, that I'm gonna, and with this particular firm or company, I literally, it was at the end of the presentation that I really realized what they were trying to do, and I was like, look, I'd be willing to help you because it's a cluster, what.
Yeah.
But again, it's ease of story. And then I always, with my team and I always try to answer the question when we're making a due diligence decision, an investment decision, is what about you and your team are the best people to execute on this strategy, better than anybody else? That's the one question we need answered. So if I can't, and we're looking for certain things. How long has the team been together? How long have you been investing? Did you work at Target for the past 20 years and woke up and said, hey, I want to start a Web3 company? I don't know. It could happen, but I want to know like where you got your knowledge from. How did you and your team become experts? What have you done before, right? And how are you going to execute the strategy? There's some very basic things. Like I said, it's not super sexy, but at the end of the day, if you can't effectively communicate that to someone who's like sitting across from you and can write a check, that's death.
That is death. And on that, we're going to end on that note. But please give a round of applause to our amazing panel on this session. I love this conversation.